Hello and welcome to Ticker Tapes. Today we're taking a look at the world of high growth stocks. They say it's always darkest just before the dawn, and after a week that saw the NASDAQ Composite Index fall by 5.1% with the narrowly focused NASDAQ 100 Index falling by 4.6%, we could certainly do with a new day feeling to lift the mood. And right on cue, strategists at JP Morgan and Goldman Sachs have pointed out that growth stocks could be due for a rally. Goldman highlighted the fact that European growth stocks now stand at an extreme discount when compared to value stocks in the region, and that, according to its research, when the sector's relative valuation reaches these lowly levels, it tends to outperform over the subsequent 6-month, 1-year, and 3-year timeframes. Whilst JP Morgan believes that following the recent pullback in equity markets and the Fed's aggressive tightening, there is now an opportunity for what it calls another tactical bounce in growth stocks, similar to the move seen over the summer months. Hard to imagine, though, that scenario is right now. It pays to be prepared for the unexpected. So which growth stocks have fared the worst over the last month, a period in which the NASDAQ 100 fell by 12.19%? Chip manufacturers are among the biggest casualties, with the Philadelphia Stock Exchange SOX index, which tracks the chip sector, falling by 15.9% in that time frame. After a string of profit warnings, NVDA fell by 27.15%, dragging names like Advanced Micro Devices, Applied Materials, and Intel lower with it. Network security names have also been hit hard, with CrowdStrike down by 16.62%, Datadog by 15.25%, and Palo Alto Networks falling by 14.89%. One thing that these names have in common is that they are all high beta stocks. That is, they are highly sensitive to moves in their underlying indices. As such, they experience a proportionally larger move in their share price when, say, the NASDAQ 100 moves sharply in either direction. That means if we do see a technical rally in growth stocks, as envisaged by JP Morgan and Goldman, then these are just the type of stocks that should participate in it. The idea that growth stocks are due for a bounce is backed up by some market indicators too. For example, the percentage of stocks within the S&P 500 information technology sector that are trading above their 50-day moving average is only 1.31%. As we can see in this chart, that's an area from which this indicator has bounced strongly over the last 5 years, and it may well do so again. Earnings season will be with us again in just under 3 weeks' time. Analysts' expectations are low with a lot of bad news priced in. As such, they don't represent much of a hurdle. And if growth stocks have performed better than anticipated over the last quarter, then that could be a catalyst for a sector-wide rally.